the Bank of Canada press conference today following the rate cut decision, Tiff Macklem said that so far it looks like a soft landing. But when asked about the rate cut impact on the housing market, which has obviously stalled out a little bit, Deputy Governor Carolyn Rogers had some interesting comments. Here's what she had to say.
We continue to point out housing as a risk to our inflation forecast. So it's something we're going to continue to watch. Ultimately, what we target is inflation. We don't target any particular measure in the housing market or an interest rate. But it's clear there is some pent-up demand in the housing market. We'll see how it goes.
We'll see how it goes. We've got Barry Fenton, President and CEO of Lanterra, joining me on the desk, Francis Donald of Manulife, and Earl Davis of BMO. Let's get the economist perspective first before I get Barry's perspective. Francis, I'll start with you. How do you model, how do you think about, the rate cut cycle and the impact to the housing market?
In short, Amber, we model it very differently than we did even 4 to 5 years ago. This is a housing market which is decreasingly rate sensitive. It is still impacted by rates, but the supply side issue, the massive increase in population, is dwarfing the interest rate impact for the most part. It's no surprise to me that the Bank of Canada is trying to distance itself a bit from this affordability crisis in housing. And yeah, they probably had a hand in this in the past decade, but in the past 4 years, this is largely a population growth story combined with these structural issues. I wouldn't be surprised if they continue to try to distance themselves to the housing market and their responsibility for any inflated prices there. I
guess, Francis, it will be then maybe a bit of a relief, though, that, that they can cut rates and not risk. Well, they're not the reason that they're creating sort of an inflammation in housing again.
Well, regardless, as Carolyn Rogers told us, inflation is their mandate. So once again, the central bank, all central banks globally, are dealing with inflation that is still a little bit uncomfortably high, but due to factors that are less and less in their control. That's got to be real hard to be a central banker right now when you're given a mandate and you have less ability to control it. That's very true of Canadian housing. And again, why I think the Bank of Canada is going to talk a little bit more about how that's not as much in their control. They don't want to risk recessions in order to try to control things that they can't. This is going to be a theme for central banking and also central banking in Canada for the next few years.
Barry, you're literally on the ground floor of this. Rate cuts are just one of the considerations that you have to make when deciding, am I going to build more? And policy wants you to build more, right? You're the supply side of the equation. Your thoughts on a rate cut?
Well, first of all, if we don't build more, we're going to have bigger problems than worrying about interest rates going up or going down by a half a point or a point. I think that the market needs to calm down, kind of chill, and I think we need to get going again on new releases and condo projects and just a good theme. Because I think right now, the talk of the day from everybody is just the fact that are they going to cut a quarter point or half a point? To be honest with you, I don't even think that the interest rate cuts, of whether it's a half or quarter, really mean much to the housing market, except for the fact that if you have some people that, of course, want to buy product now, they're very sensitive to the rates. But at the end of the day, I have not seen a big correction in the market at all. There's no question that, all of us are talking and sitting around the fire camp and saying, what's going to happen tomorrow? And are they going to cut half a point or 1/4 point? And a lot of us have not launched new projects. So that's going to be a problem, because once we get going, there's going to be a whole issue of they're going to be complaining about the fact that the values have gone up 10% over year for the next 3 years.
Because the demand side hasn't been adequately addressed. But on the supply, so there's this fascinating mismatch where demand is high. You're telling me demand is high, but you're not building projects. Doesn't a rate cut make things a little incrementally better for you when you're doing your analysis?
It makes it better, there's no question. But, we need more than a quarter point rate cut to kind of get going on.
Francis says you might get 3 or 4. Does that help?
I think we're going to be 1.5% over the next year and a half, but I'm not fantastic.
Rate or cuts?
No, I think we're going to be down 1.5%. But I follow also, I track the mortgage rates, and maybe you can help me with this, Earl. And I've noticed now that the 5-year rates are coming down substantially, which is very healthy. The variable rate really never worked anyways. So I think that the long-term outlook is that rates will come down. But I think people can figure it out. I think the problem right now is more on the development community side, where we really just don't want to activate the push button to launch new projects. I think it's more coming from our side than it is from...
Why?
because I think, one, the cost of borrowing money is very high. And two, you need certain pre-sales in order to get going on construction financing. And right now, it's going to take a lot longer in time to actually gain the confidence back from the investor community to go forward.
Yeah, and I think we kind of touched upon it. There's two interest rates that are very important for the housing market. There's the variable rate, and we've had to move on that recently, and then there's the 5-year rate in Canada. We have seen the 5-year rates come down, but they've come down not because of Canada, they've come down because of the U.S. We've seen a significant rally in 5-year rates in the U.S. over the past week alone, almost 20 basis points, if not slightly more, and that's impacting Canada. So I do think this is marginally good. It's going in the right direction, but we always have to keep our eye on the U.S. for the longer term rates, and I think that's an important qualification.
Yeah, I mean, the other thing is I keep looking at where the market was 2 years ago and where we are today, and we really have not had a substantial correction in the market. There's no question that we haven't had a lot of new startups and a lot of, there's a lot of inventory for sale, and you're not getting the same traction of things staying on the market for only a few days. But we have not had a correction, and I have to tell you, that tells me something. It tells me how strong the Canadian housing market is and how resilient we are. Because
well, Francis was kind of bringing that point up, that the demand side, the fiscal policy side, or what's happening on the government side is really kind of the overwhelming factor here. Francis, any thoughts on whether or not, you talked about that quarter point not really mattering as much? If we get 3, 4 cuts, as you suggest, does that start to move the needle?
Well, look, Amber, the last couple of months we've known the Bank of Canada has already indicated rate cuts are coming, they're on the table, and yet the housing market has been relatively soft in the last couple of months. So I'm not seeing a big correlation between a little bit of a rate cut and what we've seen in housing. I have to agree with the other panelists here. The issue is we have had extreme population growth. We're growing our population by over 3% year over year. That is enormous. Those issues are becoming more important, and it's going to take us time, Amber, to deprogram from the idea that little rate cuts here and there are going to make an aggregate difference. It will matter in a very significant way to a segment of the population that is on variable rates. If we do get, as I expect, a descent towards 3%, so that would be 200 basis points total over the next year and a half, that will be very impactful to those who are carrying debt and those who need to refinance, which is still over half of the Canadian population. But is it going to bring home prices down? No, and that's the big difference. Yes, rate relief will help with those interest payments. Is it going to change the composition of the housing market? Not when we have such a massive supply-demand difference. Maybe that's the differential we should be placing here. Debt servicing versus aggregate pricing. They're going to diverge, and they haven't done that in the past, but in this market, they will.
Francis brings up an interesting point about the payments that people are facing, and for those people with the variable, immediately beneficial, but also in 2 years, 75% of all mortgages renew by 2026. And wouldn't it just be a little bit better for those people? It's going to be at a higher rate, but wouldn't it be better if that higher rate is 3.5% instead of 5%? And you're talking about the ancillary effects to the economy being less damaging, right, when it does occur at those lower rates.
Yeah, it's important. So here's, I'm going to just continue that for a bit. The Bank of Canada today, they're like a fireman. After you have a big fire, you usually see the truck outside the house overnight to make sure it doesn't come back up, and then they can leave. So today, basically, Governor Tiff Macklem has left. He's like, the fire's out, and it's good. What happens if it's not totally out and people get more money, disposable income, because their interest rate payments are down, that goes back into the economy. This is where excess supply and excess demand, you have to be careful in how you look at it, and you have to be sure that inflation has been tamped out before you start lowering your rates.
The other point is that and again, I'm not an economist, but when I look at the cost of things today, things are probably up 8 to 10% or 12%. So even if we're able to bring inflation down to 2%, the level of playing field now for the actual cost of things has gone up substantially. So I think one way to really help the market and have affordability is to really bring those rates down fast and hard. And that's what I'm hoping for. So 2 years from now, it's not a 5-year wait period. It's a 1.5 to 2 year period where we see substantial rate reductions. And that's for sure is going to help people affordability-wise across the board being able to manage better their whole financial affairs. And second of all, I think the housing market, just to repeat, I think the housing market stands on its own. I think that we all agree that there's so much demand and lack of supply that it would really take something substantial to put that market upside down.
And you've said even without immigration, you can absorb. The demand is,
Yeah, there's no question.